If you're retired or retiring soon, the most dangerous mistake you can make is chasing yield because high income doesn't help if your portfolio can't survive the market. Today, I'm breaking down the best investments for retirees, not based on hype, not based on headlines, but on income durability, volatility control, and real world retirement math. These are investments designed to help you sleep at night, not panic every time the market moves. So let's get into it. Welcome back to Simply Money. Today, we're going to be looking at some very different scenarios. We're going to look at different yields and mix and match in different ETFs at different levels to see how you can survive in retirement and what kind of income you can expect. We're going to look at two different spreadsheets that I have, the Simply Money Retirement Planner and the Simply Money Portfolio Planner. We're going to dive into a lot of different numbers. Stay tuned. You don't want to miss this as we look at all the data. And what we're going to dive into is that most retirement portfolios don't fail because people didn't save enough. They fail because investors confuse income with safety. A fund paying 15, 20, even 30% looks great until markets drop, distributions get cut, and retirees are forced to sell shares at the worst possible time. As a retiree, your goal is not to beat the market. Your goal is to make sure the money shows up every month without blowing up the portfolio. Before we talk about specific investments, every retiree portfolio must follow three rules. Rule number one, income must be repeatable. Rule number two, volatility must be manageable. And rule number three, you shouldn't have to babysit it. If an investment breaks even one of those rules, it doesn't belong in a retiree portfolio. Now, remember, this is not financial advice. This is for informational and educational purposes only. Please do your own due diligence and know all investments come with risk. But if you've looked at the headlines, you've seen that people think they need $1.46 million to retire. And if you've listened to Susie Orman, you're going to need $5 to $10 million to retire. And that may be the case if you have a big house, still carry a mortgage, have a couple car payments, have a summer home, and live in a high cost of living area. But for the average American, they only need about $58,000 of income. And we have to remember that also includes Social Security as well. And one of the charts we're going to look at is going to factor in Social Security and how long your income will last at different levels. Let's start with our core foundation for retirees. And again, this is my opinion, and you may have differences on these, and please feel free to leave those in the comments below. I'm always open to suggestions. There are funds maybe I haven't analyzed and looked into or even heard of that you have. I'm always open to hearing about those and doing more research to present and to provide the data for you guys, and I appreciate your support. But SCHD is my number one pick, and if I had to pick one investment for retirees, this is it. Because SCHD holds profitable, dividend paying companies with strong balance sheets. And before you click off and say, oh, another SCHD video, I'm going to share some other ETFs, and then we're going to look at how to get more aggressive in case you need more income and knowing the risks that come with that. Although SCHD doesn't pay the highest yield, it doesn't move the fastest, it does something far more important. It holds up. SCHD provides real dividends, lower volatility, and income that grows over time. This is the kind of investment retirees build around. Secondly, we want to look at best monthly income, and for me, that's SPYI. Most retirees prefer monthly income, and SPYI is one of the better ways to do it. It uses options on the S&P 500 to generate income without abandoning diversification. You get broad market exposure, monthly cash flow, and less dependence on any single sector. This is the type of ETF retirees use as paycheck replacement, not a speculation. Now, one of the alternatives we're going to look at is tech-based income, and that's QQQI. If you want income but don't want to abandon technology completely, Triple QI is worth a look. It takes the NASDAQ engine and converts volatility into income. That comes with trade-offs. More volatility than SPYI, higher income potential, but capped upside. For retirees, this works best as part of the portfolio, not the entire plan. Again, never put all your eggs in one basket. That is my opinion and my advice for you. Now, if you want a lower volatility option for conservative retirees, we can look at JEPI. And for some retirees, they don't want maximum income, they want maximum calm. JEPI trades upside for stability. Lower yield than some funds, yes, but smaller drawdowns, smoother income, and less stress. And that matters more than people realize. If you're looking for a little bit of a blend of dividend and options, we have DIVO. It focuses on dividends first, options second. It won't pay the highest income, it won't grow the fastest, but it protects capital while still paying you, which is exactly what many retirees need. But don't forget, retirees still need growth. Now, here's something many retirees overlook. Even in retirement, you still need some growth. Not for excitement, not to beat the market, but because inflation doesn't retire when you do. If all your money is locked up into income only investments, your purchasing power slowly erodes, even if the checks keep coming. That's why the best retiree portfolios include a small, intentional growth sleeve. Now, stay tuned. We're going to be mixing these in different positions and different allocations to see how much income we can generate. And with different amounts invested, how will it hold up in retirement? But before we do that, I want to share a couple growth funds to consider as part of that portfolio. You have VIGIX or SCHG if you want a little bit more upside. Because for retirees, growth means quality, companies with strong earnings, pricing power, and balance sheets. Funds like VIGIX and SCHG focus on businesses that grow profits faster than inflation. This is not money you live on today. This is money that protects your lifestyle 10 or 15 years from now. Now, let's dive into the allocations in the different scenarios as we look at the spreadsheets. Now, the first one we're going to look at is the Simply Money Portfolio Planner. This is how we're going to set it up, and we're going to look at the different allocations and what kind of income it produces. And if you like these spreadsheets, you can always get a copy of them down at the Buy Me a Coffee link in the description below. But I've created these for myself and for the audience to be able to share in the community and look and take your own personal information and plug it in and see where you stand and how it would fare for you. So we have all the different tickers we've talked about right over here. And any ticker you want, you can just come down here and there's a drop down with a bunch of them in there. And if you end up buying this sheet and there's not a ticker you want, just simply email me and I will add it so you'll have those on your sheet and it's customized for you. Now, remember, all this data is historical, and as we project future, we don't know if this will hold up. So we've had to look at that and we've put that in, and we make the assumption that it will hold in the future, but we don't know. Please keep that in mind. You have the yield that it's been paying, and then the appreciation of the share price right here. We're going to start out with our first allocation where we have 40% in SCHD, 20% in JEPI, 20% in VIGIX, and 20% in DIVO. And this is our conservative model, and we've started here with $300,000 in the portfolio. And this is what we're starting with. You can put zero and use this to build your portfolio and to see how it grows. Or if you have more or less, you can put that in here. And we're just doing this. We're starting with $300,000 and we're going to put some different figures in and see how it holds up. As you come down, you can see that allocates 100% of the $300,000. It shows you right here in column E how much was allocated to each of these based on these percentages that you chose. And as we come down here, it shows us the average yield based on these allocations would be 4.28%, which would give us about a $12,000, just under $13,000 annual income, or $1,000 a month. Our moderate portfolio, we're looking at 30% in SCHD, 10% in JEPI, 10% in VIGIX, 10% in SPYI, 5% in QQQI, 15% in DIVO, 10% in SCHG. And then I've added one here for those that want to be a little more aggressive. We have the high yielding, high flying chippy right now. We're just going to put 5% in there. And then we've added GPIQ as an alternative here to get a little bit diversified and different look with 5%. And that brings our yield to about 6.42%, or about $1,600 a month. Now, to go a little bit more aggressive, those who can tolerate it, and again, we can pull this down if 4.25% is too high. We can pull this down by adjusting these percentages, or you can pull it up if you want by adjusting them. But with the aggressive scenario here, we're going 20% SCHD, 10% VIGIX, 15% SPYI, 15% QQQI, 10% DIVO, 10% SCHG, 10% CHPY, and 10% GPIQ, which gives us just over 8.5% yield and a $26,000 annual income, or $2,164 a month. Now you can look at that. We're doing this on $300,000 and we're not accumulating for any years. We're just taking it as income. In this scenario, all we have to do is come over to the forecast, and we have here the conservative, which we chose right here in the model. And you can see how the first month, your income generated, income paid out, and you can see how it grows year over year. So you are getting a modest income pay raise because of the allocations and how that is growing. And we want to look at these different scenarios. The first thing I want to do is start with this conservative. If you have $300,000, it's a far cry from the $1.4 million. But if you're average and you need $58,000 to retire, we can come over here to the Simply Money retirement template, and we put the starting balance of $300,000, the income we need of $58,000. We're going a little conservative. I always, even though the chart over here shows the appreciation higher, I like to go conservative because the stock market is not linear. It's going to be very volatile. And so I like putting it conservative just to see worst case scenario type things. We have inflation at 3%. And I know some people are going to say, wow, inflation's way higher than that. You can put that up higher if you want. But long term, that has been the average. We're going to see for 30 years, we have it inflation adjusted. And I put in our conservative return that we pulled on the other sheet, this 4.28%, which we got here in the portfolio engine, this 4.28%. We're going with a dividend growth CAGR of 2%, which is, again, very conservative with this model that we're using. And then the average person, and I've gone a little conservative on that, gets about $18,000 for Social Security. Now, if you think you're going to make more than that, and you can go to the ssn.gov and get an estimate of what your Social Security will be, or if you already know what it's going to be, you can put that in here. And we're going to say that's starting at age 62. And we're going to say the second person, the spouse, has got $9,000. We're just doing half as a spousal benefit. And again, theirs may be less or maybe more, or you may not have a spouse. You can put that at 0. And then the retirement starting age is based on the age of the first person. There's a 2-year gap here. You can adjust that as well. But we're starting with the first person getting it at 62. Hope that makes sense. I can explain that further. If you have questions, leave that in the comments below. With this, you can see starting at the first year, your balance is $300,000. You need $58,000 of income. The dividend's going to pay you $12,840. Your income from Social Security is $18,000. Person 2 has 0 for these first 2 years. That means you have to withdraw. That means your income, dividends, and Social Security is $30,840. So you need to withdraw still in this portfolio $27,160. So there's a lot to be said there. This is a tough portfolio, and you can see your withdrawal rate is very high. And we'll just kind of cut to the chase on this one. You can see you run out of money at age 77, right in that range on this model. Now, we're going to come back over here and say, what if we went to the moderate portfolio we set up? We have a 6.42%. We're going to change this to 6.42% and see what happens. Doing that, you can see you've increased your dividend payment to that $19,260. Your Social Security stays the same. Everything else is the same. You only change the yield that you're getting. And you can see this would last till about 83. So better, but still very, very risky. I wouldn't be very comfortable doing that myself. So let's say maybe you want to go a little bit more aggressive and you do the aggressive portfolio, which would be 8.66%. Again, we just changed this dividend yield to 8.66%. And this shows that it would last us until 96. Again, that's on $300,000 if you needed $58,000. And this is not perfect. That's obviously not taken in sequence of returns and other factors that you'd have to consider. This is not guaranteed by any means, but this is just a calculator that you can use to help plan. You have to remember retirement or living on income off of investments is not a cut and dry rule. People talk about the 4% rule. It is not the law. It is a guide. And all of these tools and all of these scenarios I'm showing you, when I'm planning my retirement, I'm using them as plans. I do different scenarios and I look at different tools and different allocations to see what if. And we'd never know. All of this could be blown away. We could do way better or we could do way worse. But it gives you a peace of mind when you can run various scenarios and see how it can work out. Now, with $300,000, with the more aggressive portfolio, and again, you'd have to realize that's going to be with more volatility, more sequence of return risk, different things you have to consider, but that could provide you the income you need to be able to retire if you needed $58,000. Again, lots of different factors you individually would have to change here. Now, I want to come back over here. We're going to change this to $400,000. Now, nothing changes on the yields. You can see here the annual income goes up on each of these scenarios. So we're not going to go through anything on here didn't change other than, let's say you're retiring and you have $400,000. We can come back over here. Let's come back down here to the 4.28% return, but we're going to change this to 400,000. Well, that makes a big difference. $100,000, even on the conservative level, gets you down to age 87. So that is a way to be able to look if your income or your portfolio is higher or lower, you can change these. And this is the wonderful thing about these tools. You can look at them and see what would it do in these different scenarios, and you can play around with it. Again, maybe your Social Security is higher than this. Maybe you need $100,000. Maybe you only have $200,000 of a nest egg. What is your position? When are you going to retire? What are your Social Security numbers going to be? And on this one, maybe you want different funds. Maybe you want to be a little less aggressive or a little more aggressive. And you can play with all of those different numbers on here and see. But the good thing is, just in these very rough examples and models, you can see you do not need $1.42 million to retire. I'm just telling you, unless you're in those high expense areas, high lifestyle areas, you do not need that amount. With this, you could also say, okay, I have $10,000 and I'm just starting out and I want to see where I'm going to be in 20 years. So you accumulate for 20 years. And then you can come over here to the deposit rules and say, hey, I'm going to add $500 a month starting on month one. I'm going to do that for 20 years. And for this model, you can change here what percentage of this deposit goes into the various funds that you have picked on this portfolio here on the tickers that'll show up here. And then you can decide, hey, I want all 500 to go in SCHD, or I want it to be 50-50. And you just drop down and put the percentage you want. This percentage is simply what you're adding to it. And in this case, monthly. You can come down if you get an annual bonus, maybe you get a one-time inheritance, or you get a quarterly bonus. You can add those in as well and put those in to see how it will affect that. And then you can come over to the Forecast Pro and you can see you started out, and this is set because on this here we're set at the conservative model. This is showing how it would grow on the conservative model. So it's just in these funds right here. And we can come over here and see how individually it's being deposited and what your total portfolio and how the income's growing. You can come down to year 20 and see where you'd be at. And we'll get down to year 20. And so you're looking at roughly $1.1 million. And again, this is based on past performance if it holds up on this different model. So you can do all these different things with these spreadsheets to test your place. What tickers do you want? What percentages do you want? But in my opinion, this is just a sample. And a lot of these are tickers that I own. And I have an income portion, I have a growth portion. And what do you want to accomplish? What is your risk tolerance? Are you looking for just growth? Maybe you want to just simply go all growth. So you take all this, put it to zero, zero. I'm going all VIGIX. So I'm going 100%. And I go to zero there, and I'm all growth. My yield, 0.39%. You're not going to get much income, but you can look and see what would your outcome be after so many years in all these different scenarios. That's it. Are you retired? Do you like this type of stuff? Do you want to see more of this, different scenarios? Leave me a comment down below. I appreciate you joining me. I appreciate all your support, all the wonderful comments and interaction as we build our Simply Money community to help one another achieve our financial freedom. We'll see you next time on Simply Money.